Ladies and gentlemen, a quiet storm is brewing across the Pacific. Imagine a world where every product, from the smartphone in your pocket to the solar panels on your roof, suddenly costs double or disappears entirely. That world might already be here. Recent reports indicate that China, the manufacturing powerhouse of the world, is tightening its grip on exports to the United States. So it begs the question, will China's decisive move empower smaller nations to reconsider their dependence on U.S.-led trade systems? And could this mark the end of an era where the U.S. economy dominated global trade? For decades, the global economy has revolved around a U.S.-centric model. But as China asserts its economic independence, the balance of power is shifting. A recent Bloomberg report reveals that U.S. imports of Chinese goods dropped by 20% in the past year, signaling deliberate decoupling efforts. Meanwhile, trade between China and emerging markets, such as Brazil, India, and ASEAN countries, is thriving. The real question becomes, is this the tipping point where the U.S.-led order begins to crumble? Recent trade statistics paint a compelling picture. In 2023 alone, China expanded its trade with the BRICS nations by 30%, signaling a deliberate strategy to pivot away from U.S.-centered economic frameworks. These numbers underscore a broader transformation that could shift global power dynamics in unprecedented ways. Please like and subscribe. Leave your thoughts in the comments. Your support helps us grow. Thank you. Consider this. Over 90% of the world's rare earth minerals, critical for semiconductors, EV batteries, and military technology, are processed in China. A White House report from 2021 described the U.S. reliance on Chinese rare earths as a national security risk. Yet, little progress has been made to address it. With a potential export halt, industries dependent on Chinese components, like automotive manufacturing and renewable energy, would face crippling shortages. According to the Semiconductor Industry Association, the U.S. produces only 12% of global semiconductors, while China dominates over 50% of the supply chain. Could America's tech giants survive such a blow? This is a wake-up call for the U.S., says Peter Zeihan, geopolitical strategist. China's export control mechanisms are a direct challenge to the complacency of Western supply chains. The ripple effects would be catastrophic. A recent study from McKinsey estimates that rebuilding a self-reliant semiconductor industry in the U.S. could cost over $1 trillion and take more than a decade. This creates an existential question. Can the U.S. afford such an undertaking, or will it be forced to compromise its geopolitical stance? Look around your home. Almost everything, from your TV to your kitchen appliances, carries the Made in China label. What happens when these goods are no longer affordable or available? According to a survey by the Consumer Technology Association, over 70% of electronics sold in the U.S. are sourced from China. Already, Americans are feeling the pinch. The Wall Street Journal recently reported a 15% price increase on electronics linked to ongoing trade tensions. Imagine doubling that. A halt on exports would force consumers to rely on domestic substitutes. But can U.S. manufacturers ramp up production fast enough to meet demand? Historically, it's taken years for domestic industries to adapt to supply chain disruptions. Moreover, the cost to households would be significant. According to a study by the Peterson Institute for International Economics, the average American family could face an additional $2,000 in annual expenses if tariffs and export restrictions persist. This raises a crucial question. Will the public accept these sacrifices, or will policymakers face growing backlash? In recent years, China has strengthened its trade ties with emerging economies through initiatives like the Belt and Road. The result? Countries such as Brazil, South Africa, and Saudi Arabia are now pivoting towards Beijing's orbit. China's strategic decoupling from the U.S. is a signal to smaller nations, notes Deborah Brautigam, an expert on Chinese economic policy. It's an invitation to escape the constraints of a US-led trade order. India's recent decision to settle trade with Russia in rupees, not dollars, is one example. Similarly, ASEAN nations are exploring regional payment mechanisms to reduce reliance on Western financial systems. These shifts raise critical questions. Will this empower nations to forge more equitable global alliances, or will it deepen existing fractures in the global economy? Consider the rise of multipolar trade blocs. The BRICS nations now account for over 31% of global GDP, surpassing the G7, a milestone reported by the Financial Times in early 2024. Such developments highlight the potential for a new economic architecture that sidesteps traditional US dominance. Washington has long criticized its trade deficits with China, citing economic imbalances and national security concerns. Yet, the same policymakers have restricted high-tech exports that could help reduce these deficits. For instance, the US ban on advanced semiconductor exports to China, aimed at stalling Beijing's technological progress, has inadvertently widened the trade gap. The contradictions in US policy are glaring, argues economist Jeffrey Sachs. Restricting exports while demanding balanced trade is like plugging one hole in a sinking ship only to create another. A closer look at US-China trade data reveals that while imports have declined, exports of agricultural goods like soybeans and wheat have surged by 25% in 2023. This paradox highlights the interdependence that even strict policies cannot fully sever. Some analysts argue that the US policy of containment is less about protecting national security and more about maintaining its global dominance. China's technological advancements, from AI to quantum computing, pose a direct challenge to US hegemony. A report by the Carnegie Endowment for International Peace highlights how restrictive policies may backfire, pushing China towards self-sufficiency faster than expected. The more the US tries to isolate China, the faster China innovates, says Martin Jacques, author of When China Rules the World. Could this strategy inadvertently accelerate the very outcome the US seeks to prevent? Moreover, China's recent breakthroughs in 7-nanometer chip manufacturing, despite US sanctions, demonstrate resilience. This raises the question, is the US containing China, or is it inadvertently driving China's rise? In the 1980s, the United States imposed tariffs and trade restrictions on Japanese automakers to protect domestic industries. While these measures provided short-term relief, they also forced Japanese firms to innovate and diversify globally. Toyota and Honda emerged stronger than ever, capturing significant global market share. Could a similar scenario unfold with China? Historian Graham Allison warns, if history teaches us anything, it's that economic containment often produces unintended consequences. The parallels are striking. Today, China is investing billions in global infrastructure projects, much like Japan did in the 1980s. The question remains, will history repeat itself, or will the United States adopt a strategy that fosters collaboration instead of conflict? Financial sanctions have been a cornerstone of US foreign policy. However, overuse of this tool is prompting nations to seek alternatives. China's yuan-based trade agreements with countries like Russia and Brazil are gaining traction, while the BRICS bloc explores creating a new reserve currency. Data from the International Monetary Fund shows the US dollar's share of global reserves has fallen from 71% in 1999 to 58% in 2023. Could this trend signal the decline of dollar dominance? If the dollar loses its central role, the US will find it harder to impose its will globally, warns Eswar Prasad, a Cornell economist. The stakes are high. A shift away from dollar reliance could upend global markets, triggering inflationary pressures and destabilizing economies reliant on dollar-denominated trade. For decades, the U.S. championed free trade and open markets, yet recent actions, from imposing tariffs to blacklisting Chinese firms, tell a different story. The so-called rules-based order is collapsing under its own contradictions, says Kishore Mahbubani, a former Singaporean diplomat. Emerging powers are demanding reciprocity and mutual respect, challenging the U.S. to live up to its own ideals. Is the world moving towards a multipolar system where no single nation dominates? And if so, what role will the U.S. play in this new landscape? While the challenges are immense, crises often breed opportunity. Could this be the moment for the U.S. to reinvest in its infrastructure, boost domestic manufacturing, and prioritize innovation? The U.S. has the resources and talent to rebuild its industrial base, says economist Mariana Mazzucato. But it requires a shift in mindset from obstruction to construction. Programs like the CHIPS Act, which allocates $52 billion to boost semiconductor manufacturing, are steps in the right direction. Yet, more comprehensive policies will be needed to ensure resilience and competitiveness in the years ahead. As we conclude, one thing is clear. This is no ordinary trade disruption. It's a moment of reckoning for the U.S. and the global economy. Whether this crisis heralds the collapse of the U.S.-centric order or sparks a renewal of American strength depends on the choices made today. But one question remains. Are policymakers ready to rise to the challenge, or will history repeat itself yet again? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.